Hey everyone, welcome back to my channel. So I'd like to do a little something different today. So in the interest of transparency, I'd like to show you what $1 million portfolio looks like. So first of all, please like and subscribe to this so you can see further updates and things that I push out. But right now I'd like to share my screen and give you an idea of how I set up a portfolio, and how you set up yours will be completely different because uh, the number of stocks you have will be based on your risk tolerance and your knowledge of the individual stocks. So for instance, if you are not very risk tolerant and you don't know anything about stocks, you're perfectly fine just buying the S&P 500 index. It's got 500 stocks in there, well diversified across the US and international exposure, everything you need. If you do know more about stocks and you want to pick some individual stocks, that's fine. And the number you pick will be up to you. The more number of stocks you have in your individual portfolio, less volatile your portfolio will be, but it'll also be less likely that you'll outperform the S&P 500 index. So if you only had one stock, you're either going to outperform or underperform the index almost 100% of the time. And as that number goes up, your volatility is going to go down, but your returns will look more like the index. So the more number of stocks you have in your portfolio, the less likely it'll be to outperform the index. So if you had 500 stocks, just like the S&P 500, but you were balancing them differently, you're probably not going to beat the index because there's too many stocks there for you to follow and to know a lot about. So you're just going to be guessing. And as I said, if you've got one, you've got a 50-50 chance of either blowing the doors off the market or really underperforming. And the number of stocks that you want is going to vary, but you do want some diversification. So let me pull up my index and then we'll walk you through this. So here's the allocation I have in my taxable account. So it's not my IRA and not my Roth IRA. This is my regular taxable account. And right here, it's almost $1 million. It's 900 and change. And then I have, if you add my IRA and my Roth IRA, it'll take you to $1 million. And I have these same stocks in those non-taxable accounts, but in about the same sizes. So the first thing you'll notice is that the big ones, the big winners happen to be ones that I have more money in. So the biggest position is Berkshire Hathaway, that's up almost 100%. Google, that's up 70. And then the other Google, it's up 45%. So Google has two class of shares. And whenever I buy it, I just look at whichever one's the cheapest. This is GOOGL is 9802. And as you see, GOOG, which is the same stock, they're just different classes, is 99.28. Generally, this other one, GOOGL, should trade for a little more because this is a voting share and the GOOG is not a voting share. But if there's a difference between one of the two, just buy the cheaper one because they'll treat you the same. So you'll notice I have 22 stocks here. The bigger ones, as I said, are bigger winners. And that's not just because I make big bets when I know I'm right. I generally start with a smaller position like this after I've studied a company. And as I get more comfortable with it, I add to it. So, you'll see at the very bottom, Grupo Televisa. This is a company that a friend and I were discussing over lunch. And he's a very talented investor. And I looked at it before and I wasn't convinced, but he was telling me the things he likes about it. So I just bought a very small position so that I see it every day and it reminds me to do more research on it. And then if it gets cheap enough where I'm comfortable, I'll buy it. The same thing you'll see. Intrepid Potash is a company that I've owned before and made money on and sold it. And it looks not extremely cheap now, but I want to keep an eye on it. So I just buy a few shares and then I'll keep an eye on it because I see it every day. And then if the price goes down a lot for no reason, I may want to add to it. And if it doesn't, then I won't. And then, as you go up, I have a reason for each of these, but they're generally smaller positions, and as I get more comfortable with them, I may add to it. So Anterix, for instance, is a company that owns FCC licenses, and I'm not advising to buy or sell. These are just the stocks that I own. They're not recommendations. I'm just telling you how I constructed my portfolio. So when you do construct your portfolio, as I mentioned, if you have just the S&P 500 index, that's absolutely fine. You don't have to keep an eye on it. It's diversified for you. And if you do want to pick individual stocks, just keep in mind that the S&P 500 index is cap weighted. So a company that is bigger would represent a larger part of the index. So for instance, Apple is a $2 trillion market cap company. So that represents 7.1% of the index. Microsoft is over $1 trillion, and that represents 5.7% of the index, I believe, and Google represents 3.6% of the index. So just with those three names, you're over 15% with those three stocks. So the thing to think about there is there's tons of analysts who do this for a living, and they look at stocks. So there's unlikely to be something that you've thought about Apple or Google or Microsoft that they haven't thought about. So if you have stocks in your S&P 500 index, with an index, either with Vanguard or Fidelity, or buying an ETF, you've already got exposure to those stocks. And if you think it's really cheap and you want to overweight it, then you can buy the individual stock. But if you have any part of your assets in an index, you already own those stocks. You already own the very large stocks. And if you want to overweight, go ahead. But if not, don't worry that you're going to miss out because you already own it. Berkshire is the company that I've owned the longest. And it looks like a double from here, but if we break it out, you'll see something that will jump out at you. It's a little bit of a different story. Let's see if I can get this. So as you can see on the bottom, the first purchase was in 2010. This is after the great financial crisis. And it's done okay, 283%. It's up since 2010. And then the next purchase I made, it was 5 years later, and that's up 113%. And then as you see, like over time, I've added to it and added to it and added to it. And it's my biggest position now. I do know the company pretty well. And the last purchase I made was in November of last year, and that's up about 1%. It's very short term, but I do believe in the long-term value of the company. And I will say that I have read pretty much every book there is on Warren Buffett. I've been to the annual meeting. I have his compiled annual letters here, and I've read that. So I was very comfortable when I bought it. And as I said, you shouldn't invest in a company you don't understand. And Berkshire is actually a company that's harder to understand than most because there's so many different moving parts. You've got an insurance company, you've got a railroad, you've got a candy company, you've got a jeweler, you've got so many different moving pieces. And so it's difficult to wrap your head around the whole thing, but you sort of rely on the capital allocation of Warren Buffett and his ability to run a great insurance company and to hire the best people and to acquire the best companies to run internally at Berkshire. You're sort of, yeah. So great company. And, as I said, I was very comfortable owning it. So that's that. Let me pause for a second and we'll go back to something else I would like to highlight. And let's see if I can get it up here. Here's Scorpio Tankers. The ticker symbol is STING. And again, this isn't a stock recommendation. It's just to show some process here. So I started buying it in 2019. And without getting too far into it, I did do a lot of research on the shipping industry, which had been underperforming for about a decade. So I read a textbook on the shipping industry and two or three other books about shipping in general. And so I was comfortable enough that I understood what was going on there. And basically, there was a lot of money put into the shipbuilding industry over 10 years ago, and nobody made money on it because there were too many ships built. And so for the next decade, there's been underinvestment in ships. And due to some structural changes, it looked like it was time for the shipping industry to do well. And one of the theses here is what is called ISO 2020. So a lot of these, all of the ship companies had to switch to a more efficient, cleaner fuel, low sulfur fuel. And they had two options. Could either switch to a low sulfur fuel that was more expensive than the stuff that they were burning, or they could continue to use the stuff that pollutes a lot, but then they would add these things called scrubbers to their ships, which would take the sulfur and other pollutants out that was damaging to the environment. And a third option is to run your ship slower. It's called slow steaming, where you would travel slower, so you use less fuel, but you're being less efficient with your ships because they take longer to get what they're going. And the theory was that the older ships would have to buy the more expensive fuel because they wouldn't want to invest in the scrubbers because each one of them cost several $1,000,000 to outfit a ship. And if you were running an older ship that was ready to be mothballed, you wouldn't invest in that capacity. And so Sting, Scorpio Tankers, which had the newest fleet of all the product tankers, seemed to be well positioned for this because as a newer fleet, they could afford to put the scrubbers on. None of their ships were old enough that they had reached the end of their useful life, so that it wouldn't be cost effective to put the scrubbers and they would have to be scrapped. But, as other shippers were using the more expensive fuel, there's sort of a price discrepancy between your ships and their ships, and more likely to go to you. So the ships that are using the crappier fuel, they're using the more expensive fuel, they're at a cost disadvantage and more likely to be scrapped because every 5 years, a ship has to go through something called a survey. It's every 5 or 7 years, depending on the age of the ship, and upgrades have to be made and sort of brought up to code. So the thought was that as more and more of these older ships get scrapped, that makes the newer ships more valuable and sort of becomes a self-reinforcing loop because as the older ships get scrapped, more business goes to the newer ships, and the price that you charge for a newer ship goes up because there's less ships available to take the cargo. And if the prices end up going through the roof and people want to build more ships, you can't just flip the switch. If today I wanted to build a new ship, I'd have to give the shipyard $100 million. And then 3 years from now, they would say, here's your ship, give me the rest of our money. So in that interim time, you can make supernormal profits on these ships. And when I say supernormal, I mean, they could go from $12,000 a day to $80,000 or $90,000 a day for these ships. So it seemed to be well poised to take advantage of that. And I did a lot of research, as I said, and I felt comfortable. And you can see the first purchase was in October 2019, and that's up 60%. But you have to remember in March of 2020 is when the world shut down. And so there was no demand for fuel, which is what this company transports. So oil tankers provide the oil that comes out of the ground and they ship it to the refinery. And this company is what's called a product tanker, and they take the products like gasoline and jet fuel and diesel fuel and heating oil, and they transport it from the refinery to wherever it needs to go. But since no one was driving, no one was flying, this stock went in the toilet. And at one point it was down 80%. And when it was down 80%, you might be tempted to throw in the towel. And if it was a huge position size, I might have been freaked out and sold it. But since it wasn't a huge position size and I knew the company like the back of my hand, I decided to hold. And as you can see, around 2020, at $16, $15, $12, I added, not in huge amounts. I should have, in hindsight, I should have backed up the truck on this, but I added, and those purchases ended up, up 200%, up 230%, up 300%. And that's in 2.5 years. So just a reminder, if you know the stock backwards and forwards and you're comfortable with your position size, and you can hold on for longer. If you just bought a stock because you heard Warren Buffett or David Einhorn or Bill Ackman buy it, and you said he's a smart guy, and then you throw all your money in it and it goes down 50%, 60%, 80%, you're going to bail because you have no idea why they bought. So you're going to lose confidence. And if it's a huge amount of your net worth, it's going to be very unsettling. But if you get your position sizing right and you do a lot of research on the company, then you should be very comfortable with it. So I have added recently, as recently as the past month, I made some purchases, and it's down 1% or 2%. I'm not that worried. As I said, I listen to the conference call. I pay attention to the industry. I pay attention to how much these ships are renting for. And, there's something in the shipping industry and in certain other industries that benefit you when the price goes up. It's called operating leverage. So as opposed to financial leverage, which is on the balance sheet, operating leverage is the way the industry works. So for instance, with a drug company, when you make a pill, the pills cost 25 cents, right? But the first pill is $200 million and the second pill is 25 cents. So the amount that you charge for the pills, as that goes up, it's a huge benefit to the bottom line. Another industry, the airline industry. Once the airline sells about half the seats on the plane is paid for, and then every other seat is just pure profit. So if they can sell those seats for more, all that goes right to the bottom line. So unlike a car company where, let's say you sold a car for 10% markup, if you sold another $100,000 worth of cars, you make another 10,000, and then you sold another $100,000 worth of cars, you make another 10,000. With operating leverage, if your sales go up another 10%, your bottom line may go up 50 or 100%. And that's great, but it also works in reverse. So with the car company, if your revenue is down 10%, your profits might be down 10%. But with a company like this, or an airline, or a drug company, if you made X amount of money and then your revenues go down 10%, your profit might be wiped out. Familiar with the way the industry works and know a lot about the company, and that's the way that works. And here's a look at one of my bigger positions, St. Joe. And again, not a recommendation, just something to show the process. So I did start buying this as well in 2019. It may have been before that, it may have been 2018, but I sold some. And as you see, what I bought back then, around $15, it's doing really well. What happened is in 2020, we had the lockdown, and it was such a huge position in my portfolio that even though I knew it like the back of my hand, it had trouble sleeping at night because I saw my net worth dropping like a rock from this company. And so I ended up selling half the position, and I decided to keep the other half. And the half that I kept is doing really well. But the other half, had I held on to it, I would have done wonderful. And that is just a lesson about position sizing. So I did know the company really well, but it was too large a position in my portfolio for me to feel comfortable. I think if that happened again, I wouldn't feel that uncomfortable. But at this time when we were in lockdown, no one had seen this since the Spanish flu of 1920. So no one had a living memory of society living through this, and it felt like the end of the world. And you don't always make the best decisions when you're under stress like that. So I tried my best, but what I did keep did really well. And this company, rather than being hurt by the lockdown, actually benefited from it, because a lot of people who were leaving places like New York and San Francisco and didn't want to be cooped up in a city where you're around lots of other people, started moving to Florida. And this was a great place because this company develops beachfront real estate in the Florida Panhandle. So as it kept going up and up, I did keep adding to it. As you can see, I was buying in 2020. It sold at 15, and I was buying back at 20 and 25. But even though I was paying more for the company looked like a better deal because, as I said, the lockdown accelerated how they were doing, and they were developing more lots, and they were making more money, and more people were interested in moving there. And so I just kept adding as it kept going up and up. Here we go, 42, 44. And some of those have come down, and as they come down, I've kept adding. So I was buying at 42. If it dropped down to 32, that didn't scare me off. I said, the stock is down, but the company is up. The company was making more money, selling more units, developing their resort and recreational part of their business. So everything kept going well, except the stock price. And that's what you want to see. You want to be able to add to something when it's down. And if the company is going up, but the stock price is going down, that seems like a no-brainer to me. So again, this isn't a recommendation to buy. It's not a recommendation to sell. It's just explaining how I thought about something that's a big position in my portfolio. So try something here. Hold on one second. As you can see, this is the third biggest position in my portfolio, and Berkshire Hathaway and Google you've probably heard of, but this isn't one that you would have heard of. And most people haven't, but it's something that I did a lot of work to get comfortable with. And it's not something that's going to be on most people's radar, because a lot of the times the stocks that you find that are a good deal are the stuff that people are overlooking for one reason or another. And I think the reason most people overlook this one is it's not something that if you're running some type of tool that lets you screen for stocks based on things like low PE, price to book, and things like that, this wouldn't come on your radar, because at the time they weren't making much money. So it wouldn't come up in a low PE screen, because if you are not making a lot of money, but your assets are worth a lot, it might look like your PE is very high. It wouldn't come up in something like price to book, because due to the history of this company, they acquired a lot of the land almost 100 years ago. And so they were paying $1.02 an acre, and things are recorded at book value on your balance sheet. So if you look at something like price to book, this looks very expensive, but if you look at what you could sell that acreage for now, then it becomes a lot more attractive. And if you know about Florida, then you would understand this company. And I've been going to Florida once or twice a year since the 90s. I have a lot of family down there, so I was very comfortable with this company. I was very comfortable with Florida and the investment criteria. So I was very comfortable going big on this, and it's doing well. And lately the stock has come down, and that's made me add more to it, because the stock price going down doesn't bother me. If the company is doing better and better, that's a great thing. And another one, my fourth biggest position, is this company called Fairfax. And I do have quite a bit of this, and I did have some in my retirement portfolio as well. But most of the Fairfax that I have in my retirement portfolio, I sold out, and I bought Fairfax India, which is a company that they control that invests in India. And Fairfax, if you're not familiar with it, it's a company in Canada, and people call it the Canadian Berkshire Hathaway. And the guy who runs it, Prem Watts, a really smart guy. People call him the Canadian Warren Buffett. And if you've never been to the Berkshire annual meeting, I highly recommend it. But my first meeting was not in Omaha, I had gone a few times to the Fairfax annual meeting, which is in Toronto, and it's a lot smaller. Instead of 60,000 people like Omaha, you probably get 4,000 people in Toronto, but you get to meet a lot of the people in the company. I got to meet Prem Watsa, who's a billionaire, talk to him, and several other people that are famous in the value investing community. So Fairfax is a great insurance company. If you look at things that they put out, like their combined ratio, which is how much they take in versus how much they pay out. It's very good for an insurance company. It seldom ever goes over 100%. So they take in money, they pay out less than they take in, and then they invest all of it and can make money on the investments. And Prem Watsa is a noted investor, and he's done really well with his investments. And the stock has underperformed for several years, and at one point, this was down 60% in my portfolio. Now you can see it's up 34%, but it was paying a nice 2% dividend in the meantime. And I saw that the company was well run, even though the stock price didn't reflect that, so I wasn't tempted to sell. This next company, Atlas Corp, is a shipping company, and it's up 90%. And this is actually run by Warren Buffett's former number 2 guy. So now the person who will probably take over Berkshire when Warren Buffett passes away, which I hope won't be anytime soon, is the person that was trained by the guy who runs Atlas Corp now. So Atlas Corp runs a company called Seaspan, SEASPAN, and they do container ships. Container ships are those big boxes that ships carry them. And without getting too into it, the company ran into some problems. And sometimes when you have a good company with a bad balance sheet, that's easily fixed. And they brought in David Sokol, who at one time was going to be Buffett's successor, to run this company. And he's done a really great job turning the company around, fixing the balance sheet, expanding. And recently they've announced an offer to try to take the company public, which is why the stock has gone from 11 to 15. If it was down at 11, I'd still be buying it, but at 15, I don't want to sell, and I hope it doesn't get taken private. But it's one of those things where, again, I did a lot of research in the shipping industry to understand Scorpio tankers, and some of that research into the shipping industry spilled over into the container ships. And this one, there's a lot of things about container ships I don't like, but this one I thought was best in breed, and it's turned out really well, and I hope to hold it for a long time. And then, as you can see, the other stocks that I hold, as they go smaller, the returns are less, not because there are any worse companies, but just because these companies I've owned for several years. Fairfax, I believe I started buying in 2018, and Atlas, I believe I started buying in 2018 or 2019. So I've owned these for quite a while, so they've had plenty of time to compound. And some of these other ones are newer acquisitions that haven't had as much time to compound. But regardless of how long I've owned them, I haven't bought any of them unless I've done my research on it. So, I could point at any one of these, and Howard Hughes, I could tell you how much the condos that they sell in Hawaii are worth, or their master plan community in Las Vegas, or in Houston, or in Maryland. I've done research on it. Alibaba is the sort of the Amazon of China, and I can go into Ant Financial, which is their credit card finance arm, and how much they do in sales to consumers, and how much bigger market share it has in China than Amazon has in the US. But and Micron is a chip producer, and I can tell you about how the industry went from 30 suppliers down to about 4 now, and how that's a good sign. And Coupang is a great retailer in South Korea, and Anterix owns FCC. 900 megahertz licenses, and they license it to utilities for private LTE networks. And, again, none of these are stock recommendations. I'm just showing you that I wouldn't have bought any of these just because some guy on TV told me to buy it, or because I saw a professional investor who's respected buy it. Like, you have to do your own homework, you have to do your own research. And if you're not willing to do that, you're much better off just buying the index. And if you want to do a little bit of both and keep most of your money in the index and put 5 or 10% in your crazy money account, and then try some stock picking on your own, that's fine, as long as you don't need the money and you're not worried about losing it. But it's something that is an important part of the process, is to do as much research as you need to be comfortable owning it. So if you're not willing to put 50% of your net worth in it, you shouldn't put even 1% of your net worth in it. That's how I feel. So I do a lot of work, and I have probably fewer positions than most. Well, fewer big positions. The smaller positions are still things that I bought, and I will do more research on it for another year or two. And if the things that I think are going to happen start to happen and things get better, then I may add to it at a higher price, but with more conviction, because the things that I'm seeing are working out. And if the things that I predicted don't work out, then I may sell, and because it's a small position, it won't hurt me. But whereas if I threw as much as I have in Berkshire, in one of these small companies where I have an idea that something's going to work out, and then it doesn't happen, that might bother me. But anyway, this has just been a look at how I do a few things, and hopefully you've gotten something out of it. And if you have any other questions, please leave them below. I would like to put out more content, and if you have something you'd like to see, just put it below and I'll try and accommodate that. And once again, like and subscribe to this. I don't have many followers, so I'd like you to, if you enjoyed this, to be able to see the next one, and the only way that's going to happen is if you subscribe. So put that down below, and I hope you've enjoyed this. Thank you.